The U.S. China trade relationship stands as one of the most consequential economic partnerships in the world, a complex tapestry woven from decades of interdependence, competition, and conflict. At its core, this relationship encompasses a vast exchange of goods and services that shapes not only the economies of the two nations, but also the broader landscape of global trade. As the world's two largest economies, the United States and China engage in an intricate dance of imports and exports, each relying on the other for critical resources and markets. Yet, this relationship is fraught with tensions, ranging from tariffs to national security concerns that disrupt trade flows and provoke shifts in global trade routes. The flow of goods between the U.S. and China is diverse and extensive. One of the most significant commodities exchanged is soybeans, a staple in both countries. The U.S. is a leading exporter of soybeans, and China has long been its largest customer, using the beans primarily for animal feed and cooking oil. However, the trade war that erupted in 2018 introduced punitive tariffs that severely impacted this trade. Chinese tariffs on U.S. soybeans led to a sharp decline in exports, forcing American farmers to seek alternative markets and leaving them vulnerable to price fluctuations and economic uncertainty. Conversely, China sought to diversify its sources, turning to Brazil and Argentina for soybean imports, which not only affected U.S. farmers but also altered agricultural dynamics in South America. Semiconductors represent another crucial element of the U.S.-China trade relationship. These tiny chips power everything from smartphones to advanced military technology, making them a linchpin of modern economies. The U.S. has long dominated semiconductor manufacturing, with companies like Intel and Qualcomm leading the charge. However, as China aims to bolster its technological capabilities and reduce reliance on foreign technology, the competition has intensified. The U.S. government has imposed restrictions on semiconductor exports to China, citing national security concerns. This has forced Chinese tech companies to innovate rapidly, seeking alternative suppliers and investing heavily in domestic production. The result has been a race for technological supremacy that could reshape the global tech landscape, with both nations striving for self-sufficiency. Consumer electronics, including smartphones, laptops, and home appliances, further illustrate the complexities of this trade relationship. Many American companies, such as Apple and Dell, rely on Chinese manufacturing to produce their products at scale. The intricate supply chains that span both nations have created a delicate balance. Disruptions in trade can lead to significant delays and increased cost. The imposition of tariffs has led to higher prices for consumers in the U.S., while Chinese manufacturers face challenges in sourcing components and materials. This interdependence highlights the vulnerability of both economies to sudden shifts in trade policy and the broader implications for global supply chains. The tensions arising from tariffs and national security issues have not only disrupted trade flows, but also provoked shifts in global trade routes. As companies seek to mitigate risks associated with U.S.-China trade tensions, many are looking to diversify their supply chains. Nations like Vietnam and Mexico have emerged as alternative suppliers, benefiting from the reallocation of manufacturing and production. Vietnam, in particular, has seen a surge in investment as companies move production facilities to avoid tariffs and take advantage of lower labor costs. This shift has not only bolstered Vietnam's economy, but has also positioned it as a key player in the global supply chain, further complicating the dynamics of U.S.-China trade. The potential economic impact of a complete cessation of trade between the U.S. and China would be profound. For U.S. farmers, the loss of the Chinese market would mean a staggering decline in revenue, leading to bankruptcies and a ripple effect throughout rural communities. The agricultural sector, already facing challenges from climate change and market volatility, would be pushed to the brink. Similarly, Chinese tech companies would struggle to adapt without access to advanced semiconductors and other critical components, stifling innovation and growth. Consumers in both countries would bear the brunt of increased prices and reduced choices, as the interconnectedness of the two economies means that disruptions in trade can lead to shortages and inflation. Amidst this turmoil, it is essential to recognize the groups that stand to lose the most in this trade conflict. U.S. farmers, who have long relied on exports to China, find themselves in a precarious position. The tariffs have not only diminished their market access, but have also led to a loss of confidence in the stability of trade relations. Many farmers are now advocating for a resolution to the trade dispute, recognizing that their livelihoods depend on a return to normalcy. On the other side of the Pacific, Chinese tech companies are grappling with the implications of U.S. restrictions on semiconductor exports. Firms like Huawei and ZTE have faced significant challenges in maintaining their competitive edge as they navigate a rapidly changing landscape. The push for technological self-sufficiency has led to increased investment in research and development, but the road ahead remains fraught with uncertainty. Consumers, too, are caught in the crossfire of this trade conflict. In the U.S., higher tariffs have led to increased prices for everyday goods, from electronics to clothing. Families are feeling the pinch as their purchasing power diminishes. In China, consumers face a similar reality, with rising prices for imported goods and a shrinking selection of foreign products. The interconnected nature of the two economies means that a trade conflict ultimately affects the average consumer, who may find themselves paying more for less. As the U.S. China trade relationship continues to evolve, it is clear that some nations stand to gain from the shifting dynamics. Vietnam and Mexico are prime examples of countries that have capitalized on the trade tensions, attracting foreign investment and expanding their manufacturing capabilities. These nations have positioned themselves as alternative suppliers, benefiting from the desire of companies to diversify their supply chains and reduce reliance on China. This shift not only enhances their economic prospects, but also alters the balance of power in global trade. In conclusion, the U.S.-China trade relationship is a complex web of interdependencies that reflects the broader dynamics of global trade. The exchange of key goods, such as soybeans, semiconductors, and consumer electronics, underscores the significance of this partnership, while the tensions arising from tariffs and national security issues reveal the fragility of this relationship. The potential economic impact of a complete cessation of trade would be severe, affecting farmers, tech companies, and consumers in both countries. As alternative suppliers like Vietnam and Mexico emerge, the landscape of global trade continues to shift, creating both challenges and opportunities. Ultimately, the intricate web of dependencies in the U.S.-China trade relationship serves as a reminder of the interconnectedness of the global economy and the far-reaching implications of trade policy decisions.